looking into the financing part now, getting a strong understanding about the financing part of this particular reading. So the financing part, as we picked up, there are two major cash flows that we look into the financing part. First one, we look into the issue cost. Second one, we look into the tax relief. So first, let's look into the issue cost over here. What does the issue cost has to say to us? And simultaneously, we'll apply it in a sum also. When we talk about the issue cost specifically, so here 2 million is the amount that I need for my loan. Okay. And on that, 3% is my issue cost. Okay. So I want to know how much should I raise such that both of these are covered. Right? Both of these are covered. So very simple way, you take 0.97% of X. Let's X be the total loan. Let X be the total loan. If 0.97% of X, 97% of X is 2 million. That is the money that I need. How much should be my total? The total that I will raise is 2,061,856. This is the total I will have to raise. Okay, this is my total loan. The total loan I will have to raise is this. Okay, let X be my total loan. 97% of X is 2 million. The amount that I need is only 97% of the total money I'll have to raise because I have to, whatever I have to raise should include the issue cost in it as well. Okay, so this is what I would raise 2,061,856. On this, I have a issue cost. How much is my issue cost? I have a 3% issue cost on this. I have a 3% issue cost on this. So I have a total of 61,856. I have a total of 61,856. Okay, I have a total of 61,856. Okay, this is what I have a total of 61,856. This is my issue cost. So two things I figured out. Number one, how much is my total loan? And second one is how much is my issue cost? These are the two things I need to figure out. How much is my total loan? How much is my issue cost? Okay. So I take X as my total amount, total loan. 97 of it is 2 million. And if 97% of it is 2 million, then how much is 100% of it? 100% of it is 2.061 million, which is my total loan. First thing. And then 3% of that is my issue cost. Okay. So this is how we calculate the issue cost. This is how we calculate the issue cost. So now issue cost can be of equity, issue cost can be of debt. Issue cost of equity does not have any tax benefit on that. Okay. Issue cost, if you see of equity, so whenever we did yesterday, we did our base case NPV, and whenever we do the issue cost, there will be one issue cost of equity, there will be one issue cost of debt, and along there will be a tax shield. Okay. There will be base case NPV, second there will be present value of issue cost, and third there will be present value of tax shield. Okay, there will be present value of tax shield. So three things will be there. The one is our base case NPV. Then we have the present value of issue cost of equity and debt. So let's calculate for both. So in the sum that we would see here, with regards to TYU2, from the financing perspective, so when we talk about with regards to simultaneously doing a sum so that we get a good understanding here. So total amount that I have raised over here is 800,000 in this sum. Why? Because that is the money I needed, right? And this is given net of issue cost. Okay, this amount is net of issue cost. We have already included the issue cost. It's net of issue cost. 96 was the loan, 4 was the issue cost, and totally I have raised 100. Right? Net of issue cost is 96. Net of issue cost. So when I take the loan amount from the total, when we have netted off the issue cost. After netting off the issue cost, what is left is the loan amount. So in this case, the loan amount I have taken is 800,000, which is 40% from bonds. 40% of that money has come from bond. Okay, so 3,20,000 has come from bonds, and remaining 4,80,000 has come from equity. 320 has come from bond, 480 has come from equity. Okay, 320 is from bonds, 480 is from equity. So now we'll find the issue cost of each. 480 issue, we look into the equity issue cost here first. Equity issue cost they're saying is 4%, and 2% is the issue cost of my debt. 2% is the issue cost of my debt, 4% is the issue cost of my equity. Along with that, what have they told? Assume that the debt is risk-free. This year they've told the debt is risk-free. So I've raised the debt at a risk-free rate. The debt is risk-free. So I've raised the debt at risk-free rate. Now let's look into the calculation of the issue cost. So calculation of issue cost of equity. So 800K is net of issue cost. Therefore, we need to gross up. So when we talk about it, 480,000 is the cost of my 480,000 is the total equity that I have raised in this project. And then we have taken 4 of 96 because this is net part of net of issue cost. So we have taken 4 of 96. And then we have got the issue cost of equity. And same year, what we have taken 320,000 into 2 by 98 because the issue cost of debt is 2. Okay. And once we have done that, we have got our issue cost of debt. But debt brings some tax relief. So 33% of that is our tax relief. And we take 33% of that, which is our tax relief. 2155 is subtracted, which is the tax relief. This is the total issue cost of debt. Equity, we do not get any tax relief. Debt, we get a tax relief. So we have taken this. This is the present value of issue cost, present value of issue cost of equity, present value of issue cost of debt. So what we have taken 480 and 320, which was the split of 800,000. 480 was 4 by 96. 320 was 2 by 98. Why? Because we have taken the net of issue cost. Right? And they told that it was the total 800,000 was the gross amount. We would have taken 4 by 100 and we would have taken directly 4% and directly 2%. 4 by 100 and 2 by 100. Because they have given net in the question, we are taking net in the solving as well. Right? Since they are telling net, so we are taking 4 by 96. Had they not told net, we would have just taken 4% and directly 2%. Since they are telling net, we are taking 4 by 96 and 2 by 19 because the word net is given. 800 is net. When net is given, you take 4 by 96 and 2 by 98. And once we did that, we got the issue cost of equity, we got the issue cost of debt. Okay, issue cost of equity, issue cost of debt, both have been included in the final calculation. Issue cost of equity, issue cost of debt, both have been included. Okay, the only reason why we have taken 4 by 96 in this case and 2 by 98 in this case because the 800,000 was net of issue cost. So whenever they tell it's net of issue cost, you do it on the net amount 2 by 98 and 4 by 96. Okay, so these three things are done. First and second, this is done. Now we'll go to the tax sheet. Tax sheet, we take the total amount that we have raised here. So on debt, the total amount that I would have raised, right? This is my gross, this is the total loan, which is equal to the loan amount plus my issue cost, both. So my total loan that I have taken is 326. And they're telling the debt is risk-free. So I take into 10% of that. And what are the tax savings on that interest payment? 10, I'll get the interest payment here. On that, I take my tax rate. So I get the tax savings into the annuity factor for 3 years. Into the annuity factor for 3 years. Because they're telling it's redeemable in 3 years' time. Because they've clearly told it's redeemable in 3 years' time. And the debt is risk-free. So risk-free. And the risk-free rate is 10%. So 10% and redeemable in 3 years' time. So we take the annuity factor. We get the present value of tax sheet. That goes to a final calculation. Present value of tax sheet. That's it. We get the present value of tax sheet. We take the base case NPV, the present value of the issue cost of equity and debt. Only because it was net, we are taking 4 by 96, 2 by 98, plus the present value of the tax shield, plus the present value of the tax shield. So we did that and we got our APV. Okay, let's go through the calculation here, Shri. We'll start with the issue cost of equity. How did we go about the issue cost of equity here?
Yes, so first, like we'll have to issue cost like it's 4% on equity and 2% on the gross debt issued.
Okay.
So from the total, so like from 4,80,000, we are calculating to get the issue cost, which is like 20,000, because it is net, so we'll have to basically like gross it up. And for present value of issue cost on debt, it's 2% of issue cost. So once you find the debt cost, issue cost, it is basically you have tax relief on that. So on that you have to calculate tax to arrive at the present value of the issue cost on debt.
Yeah.
Then you will get the tax. So you have to add it with the deduct the issue cost with the base cost of the debt.
Okay, perfect. So
Plus
this is
have
the
the
issue
present value
cost.
of tax shield.
Perfect. Now coming to the tax shield here, how have we gone about the tax
So
shield?
tax shield is that we have to like take the total amount raised, like total loan amount raised,
Okay.
and you have to add the issue cost with that. So with that, you will get interest relief on the total loan amount because interest is generally like tax deductible. So the total amount into the interest rate into the tax, and then you'll have to do annuity factor like for 3 years to arrive at the present value. In case if the tax is delayed, then the first year's annuity factor, you'll have to discount it.
That's it. Only if it is delayed. So now let's look into the delayed bit as well. Now that this question is solved, coming back to the theoretical side of things here. If there has been any delay in the issue cost, right? If you see, if the present value of tax relief, if there's any delay, we take the present value of that particular year. Okay. So we took the issue cost here, as you can see, and along with that, we have taken the tax relief. Till here, we have done the calculation here. So this is what we got. And then with regards to the tax shield or the tax relief on the interest payments, we took the total loan amount, we took the interest rate, we took the tax rate, and we took the annuity factor. However, if the tax is delayed by 1 year, you will just take the year one discount factor. If the tax is delayed by 1 year, and 1 year is the maximum delay that tax goes to, does not go beyond that. That is about this. That is all about the APV. Looking into some advantages and disadvantages of this method of APV. It's a step-by-step approach, clear understanding, right? It's easy to understand. That's one advantage. Can evaluate any types of financing package. So however you have chose to finance, you can use it to calculate the APV. It's more straightforward than adjusting the WACC. Right? It's more straightforward than adjusting the WACC. Disadvantages are again, it's based on MM's with tax theory, therefore it ignores three risks. It includes bankruptcy risk, it excludes tax exhaustion, and it excludes agency costs. These three things it excludes. Right? It excludes bankruptcy risk, tax exhaustion, and agency costs. These three things it excludes. That is a disadvantage. And it is based on with tax theory. It therefore assumes debt is risk-free and irredeemable. Right? It is based on with tax theory. Therefore, some of the fundamental assumptions in some sum they would see that debt is risk-free, which we saw, and irredeemable. However, in this case, it was redeemable, the sum that we did, but in most sums you will see, they will say that the base assumption is that it's irredeemable. These are the disadvantages because debt will not always be risk-free. And they might have a very different rate as well. So this is some of the disadvantages, and both related to only. Modi and Miglani theory. So both related to that, relating to the fact that they are ignoring bankruptcy risk, they are ignoring tax exhaustion, they are ignoring agency cost. After that is established, then there is the assumption around the tax is risk-free, and also it's irredeemable. Also, it is risk-free and it is irredeemable. It is risk-free and it is irredeemable. It is risk-free and it is irredeemable. These are the disadvantages of this.